Good day, everyone. Today, we were going to discuss about types of major accounts. Okay, when we say major accounts, we have five major accounts. So, namely, first we have assets, liabilities, capital, income, and expenses. Okay, so when we say asset, it is the resources owned and controlled by the firm. Next, we have liabilities. When we say liabilities, it is the obligation of the firm arising from past events which are to be settled in the future. So that is liabilities. Next, we have the equity or the owner's equity. It is the owner's claim in the business. So it is the residual interest in the asset of the enterprise after deducting all its liabilities. So that is equity. Next, we have the income. It is the increase in economic benefits during the accounting period in the form of inflows of cash or other assets or decrease of liabilities that result in increase in equity. Income includes revenue and gain. Next, we have expenses. So when we say expenses, it is the decreases in economic benefits during the accounting period in the form of outflows of assets or incidences of liabilities that result in decrease in equity. So that is expenses. In asset, we were going to discuss the difference between the current versus non-current asset and tangible versus intangible asset. Okay, so when we say current asset, are asset that can be realized, collected, sold, used up to 1 year after year-end date. Example include cash, accounts receivable, merchandise inventory, prepaid expense, etc. For non-current asset, we have our asset that cannot be realized, collected, sold, used up to 1 year after year end. Example includes property, plant and equipments, furniture, building, land, long-term investment, or etc. Now, we were going to proceed to tangible asset versus the intangible asset. Okay, when we say tangible assets, are physical assets such as cash, supplies, and furniture and fixtures. When we say intangible asset, are non-physical assets such as patent and trademarks. Okay, so that is the difference between the uh, current asset, non-current asset, tangible and intangible asset. Okay, so these are the accounts belong to current assets. So we have cash, account receivable, notes receivable, inventories, supplies, prepaid expenses, accrued income, and short-term investments. So that accounts belong to current asset. Okay, so when we say cash, is a money on hand or in bank. And other item considered as medium or exchange in the business transaction. Okay, so the account receivable are amounts due from customer arising from credit sales or credit services. Then we have the notes receivable are amounts due from clients supported by promissory notes. Next, we have the inventories, are assets held for resale. Then the supplies are items purchased by an enterprise which are unused as of the reporting date. Then next, we have the prepaid expense. Our expenses paid in advance. They are asset at the time of payment and become expenses through the passage of time. Next, we have the accrued income and revenue earned but not yet collected. Then the last one, the short-term investment or the investment made by the company that are intended to be sold immediately. So that accounts belong to current assets. Okay, next, accounts which belongs to non-current asset. So first, we have property, plant, and equipments. Then, long-term investment. Then, intangible assets. So, that's account belong to non-current asset. Okay, when we say property, plant, and equipments are long-lived assets which have been acquired for use in the operations. Okay, then the long-term investment or the investment made by the company for long-term purposes. Next, we have the tangible asset or assets without a physical substance. Let's say, for example, includes franchise and copyright. So that is accounts belong to non-current asset. Next, we have the liabilities or the debts and obligation of the company to another entity. So, we were going to discuss the difference between the current and non-current liabilities. When we say current liabilities, liabilities that fall due. Let's say, for example, the paid recognized as revenue within 1 year after year end. Another example includes account payable, utilities payable, and unearned income. Okay, so that is current liabilities. Non-current liabilities are liabilities that do not fall due, paid recognized as revenue within year after year end date. Let's say, for example, it includes notes payable, loans payable, mortgage payable, etc. So that is the non-current assets. Okay, so we were going to define each account and differentiate one from others. Okay, in current liabilities includes account payable, notes payable, accrued expenses, and earned income. So these accounts belong to current liabilities. When we say account payable, are amount due or payable to suppliers for good purchase on account or for service received on account. Okay, so that is account payable. Next, notes payable are amounts due to third parties supported by promissory notes. So that is notes payable. Accrued expenses are expenses that are incurred but not yet paid. Example, salaries, payable, taxes, and payable. Next, unearned income is cash collected in advance. The liability is the service to be performed or goods to be delivered in the future. So that's account belong to current liabilities. Next, we have the non-current liabilities. So when we say non-current liabilities, it includes loans payable, mortgage payable. Next, we were going to proceed to owner's equity. So when we say owner's equity, it is the residual interest of the owner from the business. It can be derived deducting liabilities from asset. Okay, so when we say owner's equity, it belongs the capital account, drawing account. So when we say capital, it is the value of cash and other assets invested in the business by the owner of the business. Okay, so drawing, it is the account debited from asset withdrawn by the owner for personal use from the business. So that accounts belong to owner's equity. So next, we have the income. When we say income, it is the increase in resources resulting from the performance of service selling of goods. Okay, so let's say for example, service revenue for service entity, sales for merchandising and manufacturing companies. Okay, so next account, we have expenses. When we say expenses, it is the decrease in resources resulting from the operation of business. Okay, so expenses decreases equity in the accounting equation. Let's say, for example, salaries expense, interest expense, and utility expense.